Hi, I'm Ed Parcaut, your host of Inner Edison. What I'd like you to take away from today's show is, as important it is to start your business, you also need to look at exiting your business. So today's guest is Joshua Lindsey. Let's welcome him and get to know his journey and his story. Thanks for coming in today, Joshua.
Yeah, I appreciate you having me, Ed. Thanks.
Oh, my pleasure. A little bit of your background, because a lot of my listeners aren't going to know who Joshua is.
Yeah, no, absolutely right. I don't consider myself to be famous by any means. So
Not yet, anyway, right?
no. So my journey is a little bit different. A lot of people that are in the M&A space or business brokering space, they come out of selling one thing and kind of get into the next. I actually started out in sales, like high-level sales, over the phone, door-to-door type sales. And had one of the executives approach me to split off and start a company. So we launched a financial services firm. This is back in the early 2000s, where we did prepaid debit cards and ATMs.
Okay.
I was really the workhorse, so to speak, the sales guy going out. At one point, we had almost 35,000 ATMs in the Western United States. We ended up taking that company public in 2006. So I did a 2-year stint in the public realm. After that, kind of got back into the small business arena. We launched another company where we were helping kids get free money, grants, scholarships, etc. We hired some ex-BYU professors to teach and train the kids on SAT, but also the interview and the money application process. Ended up selling that company. So after that, kind of split ways with that partner and started to get into the buy and sell of companies, kind of doing family office, my own private equity work, where I was buying companies. And it was great, but a few things that I learned. One, there's a lot of stuff out there that's for sale, and not everything obviously is worth buying, so to speak. So I was going a long period of time between acquisitions, like a year, just kind of living off savings, whatnot. And as I would get into businesses and restructure them, and then I would exit, I was running into intermediaries and so-called brokers, so to speak, that were kind of in the middle of the deal doing representation. What I realized real quick was I knew a lot more about the process than they did, just by the act of doing, having sold companies and taking them public. So in 2011, just through demand of friends and family on how to put these deals together and how to help them exit or raise capital, whatever, we launched American Business Brokers. And so that really acts as a kind of a full-time business for myself, where we do hands-on representation for sellers, helping them prepare their businesses to sell. We do all the negotiation, all the contract work, all the way up and through the closing of those deals. So I've got American Business Brokers, and I've also got a private equity arm where we still actively invest in companies. So.
Okay. All right. So I want to go with, like I said from the beginning, because most people think about, focus on building and starting their business, but they never think about exiting their business. And you need to have that exit. So how do people get ready for that?
So it's a good question. And I'm going to give you a little bit of a long-winded answer. So
good. We got 30 minutes. So go for it.
So, one of the things that I think is really important is most business owners are great at running their business, and they should run their business like the exit will never come. It's not a great idea to start a business just thinking, oh, I'm going to sell this in 3 years, because oftentimes you're too distracted and too focused on the exit that you're not focused on the execution of the business. So I'm assuming that most of your listeners that are small business owners are really, focused on running the business. But with that being said, it is important to understand what your business is worth today, and also what you might want it to be worth later in order to execute that exit, if that makes sense. Because most people, either they're looking to transition into another business, or let's say they're looking to retire. There's got to be a number involved. We've kind of all got a number of what it would take if somebody backed up that Brinks truck or wrote the check that would cause you to exit. So it's not a bad idea, one, to establish the number, and two, kind of define what that would look like for you, because you do have to prepare for the exit. The hardest thing is when people just come to me out of nowhere and they're like, hey, I want to sell my business. I've done nothing to prepare. Oh, and by the way, I want $50 million. And it's like, well, you haven't prepared your business in order to get $50 million, if that makes sense.
It does, but how do they prepare?
Yeah. Okay. So let's focus on that. So again, I think it's important to establish the number, right? You can't really have a goal without knowing what your number is. So if you need $10 million in order to retire, the first thing you need to do is you need to establish your business's value today, say with the business appraisal. And then if you're at that number, great. If you're above that number, even better. If you're below that number, then you need to figure out where your numbers need to be in order to get that $10 million that you would like to in order to exit.
Okay, Joshua, so the appraisal, talk about the appraisal process, because I think a lot of people don't understand that.
Yeah, so unlike real estate, where it's pretty simple, where you just go in, you have a house, it's square footage, etc. You take comps and the 1 to 2 mile radius. It's a lot more wild west approach and a lot more research involved. And what I mean by that is there's a lot of people out there that will just tell you, oh, you just attach a multiple to say your gross earnings or your EBITDA or whatever it is. Those people have no idea what they're talking about, or they typically have not sold a business. The reason being is it's unfair to just attach a multiple, say, to a real estate brokerage and then go out and price a restaurant with the same multiple. They're not in the same wheelhouse. They're not in the same industry. And so that's why it's an ill practice just to attach a multiple. So a few things that kind of go into that appraisal are, one, your financials. You need to keep good, accurate books. And I want to emphasize a little bit, there's nothing wrong with powering down your taxable income, but you need to do it within reason, so to speak. What I mean by that is, if you're taking all the allowable add backs like depreciation, amortization, your own personal salary, insurance, cell phone, meals, that's all fine. And you're chipping away at that number that you get taxed at the end of the year, that's okay. We'll add all that back and show the actual owner net. But it gets gray when you start, say, buying a boat and writing it off as marketing. Does that make sense?
But what if you have it like their name all over the boat?
So you can get away with like a portion of that, but still it's kind of a gray area where you're like, hey, I bought this $200,000 boat and it says, Johnny's beef hot dogs on it.
Right.
It's hard to write off $150,000 for a boat.
But what if I have, I'm going to get hit with a $200,000 or $500,000 taxable, and I decide to buy a plane or a vehicle that I can write off that vehicle?
That's allowable. Yeah, that's allowable.
We're going to add the depreciation back in from what you just did.
Yeah, and the key word there is depreciation, right? That's an allowable add back. Depreciation, that'd be allowed by a lawyer, a CPA, a bank, any investor. This is an allowable add back. It's, oh, you see that $200,000 expense line? That's really not a marketing expense. I bought a boat. Different, right? It's different.
Yeah, because the IRS will come in and tell you that you're going to owe that now.
Yeah, that, and it's just not an allowable add back, like I said. So when you take this to market and you've got professionals looking at it, the key word is allowable. It's got to fall within GAAP principles. And if you're not falling within the GAAP accounting principles, it's not an allowable add back. It just gets difficult to maximize your appraisal, if that makes sense.
It makes sense to me. I don't know if it makes sense to everybody else, but I'm in the real estate space. I own a mortgage company, so I totally understand appraisals and what you're doing and what's,
right.
And as a business owner, understanding what's allowable, depreciable, that kind of stuff and what you've taken, because I had to have a bookkeeper go through all my stuff again because I had another bookkeeper who totally put stuff in the wrong place. And all of a sudden I was going to have this huge tax hit. Right. And then the lady went back through and fixed everything. Took 3 months, but it was fixed. And now there is no tax hit because everything was put where it was supposed to.
It's kind of a pet peeve of mine, Ed, is there's a lot of people in the accounting space and you think that they're all created equal, right? Like, oh, I've got this accountant, he or she will do this great job. Then all of a sudden you discover something like that and you have to take it to this new person to redo all your books. Do you find that frustrating?
Yeah, but it wasn't my accountant. My accountants are amazing. I've had them for years. When I first got in that business back in, God, I'm going to date myself, in the 90s, all of our sales guys were making ridiculous amount of money, and we hired this company to help us, and it's out of San Diego, Constantine, and they've been amazing. But they don't do bookkeeping, right? It's so hard to do good bookkeeping and have good bookkeepers. So they tell you to go find a better bookkeeper. Yeah, and I was referred to the first one. I had no idea. I'm like, how am I getting this additional hit all the time for, And then
Yeah.
come to find out she just was in a hurry. Well, charge me more money.
No, totally. 100%.
Yeah.
So, and then maybe I should rephrase the statement. It's the bookkeeper, the person that's allocating where things go. I see it all the time. And all of a sudden you start discovering these errors and somebody has to completely redo it. And you're like, hey, why couldn't it just be done the first time? I wish there was a little bit more professional pride. Like I said, like you just said, they're in a hurry and they just kind of slam it in there. And you're like, hey, they're my books. It's my business. Like, I don't want to get hit with some extra $30,000 tax bill because, you just didn't take the time to do it right.
I wish it was 30. It was 200 grand I had to take last year that I didn't get
A
money.
lot, right? Either way.
I got hit with, 50 grand in taxes where I didn't even get to enjoy the other $150,000.
Yeah. And as you know, I mean, if you're in the real estate game, you know that, it's not what you make, it's what you keep, right? And so
that's every game. That's every game.
Every game. It really is. It's every game. And so, the more you can keep and stash away, the faster that compounds. And so it's so critical. And again, it's not necessarily accountants and CPAs, but they have their own function. But, the person that's allocating and putting in the proper place, this is what I'm talking about, keeping tight books. It's really important. Also, like in your taxable life, but just also in that business preparation life. The tighter they are, the more you're going to get for your business.
And also, I mean, people need to make sure that they're structured right, whether the C Corp, S Corp, whether LLC, whatever they are, they need to be structured right. And that's having the right accountant, the right attorneys, the people in place to help you understand that kind of stuff. But we've already done that. We're in business. So now we're trying to figure out what we can do with our business and we're trying to sell it. So the first thing they do would be the appraisal. And you said it's very wild, wild west, which means that and a lot of people don't realize appraisal is opinion. It's not a fact. It's that person's opinion and what they think it is. So do you normally get just one appraisal or do you get two appraisals?
I don't necessarily think it's going to matter to get multiple appraisals. I think, so when we do an appraisal, for example, we appraise the business 4 different ways. And the primary reason we do that is because buyers and investors out there typically have their own preferred method of value. Some people focus on EBITDA. Some people will focus on discretionary cash flow. Other people will want to focus on comps, like what else is sold in the country that's similar size to yours. And then we also have people that just focus on industry, like they're an industry buyer. They buy stuff in this specific space. So when we appraise a business, you're getting 4 appraisals in one, if that makes sense. Yeah. And the reason that we do that is because when we're taking it to market, we don't want to get caught off guard by having somebody say, well, you didn't factor in the comps or you didn't factor in the industry. You specifically just focused on EBITDA. And so
hold on. EBITDA for people who are listening who don't understand that term. Yeah.
So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. I want to make sure the T was before the D.
That's okay, as long as they understand. I mean, we assume everybody listening understands all of our acronyms, what we're talking about. So you said the 4 ways you look at it is EBITDA, comps.
EBIT, so just minus the amortization.
Okay.
You're going to get a general rule of thumb or an industry. So that's whatever industry you're in, mortgage, we'd focus just on mortgages. You're going to do discretionary cash flow, and then you're going to do comps, other sales in the space, similar size, similar revenues, et cetera.
Right. I mean, the problem, like in my industry, I'm a mortgage broker. So for us to sell a company, there's really not mortgages there, right? Because we actually wholesale them off that somebody else handles. So we're only in the origination side, which is not, I mean, sometimes we get picked up because companies want to add an origination arm to their company so that they can, build their company, but not necessarily does someone come in and buy a mortgage brokerage, right? There's a company I do know that because I don't know, it's been this week that I've been a couple of weeks like talking to people about businesses, franchises, selling your business. And they had a franchise or a mortgage company, which is the first I've ever heard of that. Because most mortgage companies are net branches where that's just a branch you open up with no skin in the game just to open up a company.
Sure.
But let's get back to what you're talking about. So we were talking about the 4 ways. So the first one was, and then you said comps, and then the other 2 were?
Discretionary cash flow.
Okay.
And then you've got your general rule of thumb and industry standard. So that has to do with your industry and your area.
So basically, the cash flow is how much cash is flowing through that company. Is there a percentage that normally people look for?
No, not necessarily look for, but to give you a little context on it, most businesses that I see, small businesses, they typically operate somewhere between 20 and 30%. What I mean by that is, let's say you're doing $1 million in gross revenues, the owner net or discretionary cash flow would be somewhere between 200,000 and 300 grand. Does that make sense?
Yeah, that they would actually, you're talking about cash flow to the owner?
Yeah, cash flow to the owner. When you add all that stuff back that we were talking about, any benefits, all that stuff, that's typically representative of a healthy business.
Right. And that's after they've legally written off everything they could legally written off through the company.
No, that would be with the add back. So when we add them back, you're going to get to that 20 or 30%. I see lots of people, down in the single digits as far as their reported income. Like, hey, I only made 50 grand this year. And then when you add all the discretionary earnings, discretionary cash flow back in, you'll get into that 20 to 30%. And, look, you can be higher than that. Like internet businesses are more profitable than that. They're just more lucrative. They don't have the overhead. And like, there's some industries like medical supply, they're down in the teens, or like franchises, they're down in the teens. I'm just kind of giving you a generalization where most businesses that I see are like 20 to 30% owner benefit.
Right. And with what has happened, the pandemic, and more people work from home, you would think going forward, most companies would be a lot leaner, right? If they keep some of their work for them at home, right?
Yeah. So there's a large company here in Utah. I've got a quick story about that. They owned an entire building out by the airport, huge, like 5 stories. They were paying like, $500,000 a month in rent. Pandemic hit. They work a lot on the phones. They do inbound sales and outbound sales. And so they sent everybody home. They spent a couple $1 million on getting everybody set up at home. And after about 3 months during the pandemic, they realized that productivity was about the same. And so they just went to their landlord and they were like, hey, we're not coming back. We're out of our lease. The landlord was freaking out. It kind of like, made natural ripples across the community because it's a big lease. But they're like, yeah, we can add pretty much $500,000 to the bottom line, get the same production, and our workforce is even happier working from home.
Yeah. Well, and that's kind of my industry. All the support staff is at home, and I'm never bringing them back. And they're so happy. And it's because they show up at their desk at 7 o'clock in the morning, where I couldn't get them in here till 8:30.
Totally.
Right. And then half the day they're talking to somebody in another office, bullshitting instead of doing their job. Now they get their job done within 4 hours. I don't care. It's about doing the job, not 100%. About how much I pay you. Right. So, yeah, I mean, and that's important because more productive. So I saw more productive. I can't even talk today. They were more productive than when they were in the office because a lot less talking.
Yeah, it's interesting from an employment standpoint. You were probably pushing for that, like every other employer that I know is, how do you get the most out of your workers? But all of a sudden, when you're throwing this curveball like a pandemic, people realize, oh, I really don't have to go to the office. I just have to get my stuff done. And then if I get it done, I can pretty much do whatever else I want to do. And that's how I've been working, for probably like 15 years now, just kind of self-employed and just do what I got to do. So I've always enjoyed that. But it's been interesting to watch like employees, so to speak, just kind of make that transition and shift and realize that they don't need an office and somebody over their shoulder kind of telling them what to do. I do have one complaint though, and that is the golf courses are slammed like I've never seen before. The ski resorts are slammed. I'm like, does anybody work anymore? And I forget. Everybody just has this luxury of freedom, and people are skiing half day and playing 9 holes. And so I'm a little disappointed by that.
Well, I've been telling my people for as long as they've worked for me, it's not about the hours you put in; it's about the job. Get the work done. That's all I care about. Yeah, and that's so important, no matter what you're doing. And for my industry, it's huge. And a lot of the companies that had big leases just aren't going to come back. My company, I do podcasts, and I took over another room I have here that used to be the conference room for. I do radio, and now it looks like we're going to go to 2 hours every day, live radio,
nice.
For the show that I do, my other show I do. And so it's like, I've taken the company, I'm here, it's my man cave, and I've turned it into multiple studios, and then I'll have like support staff for that here, not necessarily for the mortgage company.
Right. Makes sense.
Yeah. So, and it's all about content these days. So back to the business, not about me. All right. So I'm selling my business. You go through the appraisal process. You look at 4 things. Everything looks good. What's the next step?
So as long as, you and I see eye to eye on the value, right? It's important that my clients are happy with the numbers that are coming out. If we're too far apart, then they're not ready. We'd have to prepare and kind of back into what they need to do to get that number. But if it hits, then we would prepare the business to sell. So we've already done the appraisal. We put together a listing agreement. They were going to sell at this price, et cetera. And then we would take it to market. And that's really where the rubber meets the road. That's when you're going to start to get the inquiries. And some of the important things on that are, when we take businesses to sell, everything is done on the blind. So nobody would know that, your business is for sale. It would say, mortgage, brokerage for sale in this part of the country. That's it. Some generalization, some numbers, and that's it. And then when a buyer or an interested party wants to request more information, we're pretty strict here. They've got to sign a non-disclosure and a non-circumvent form. It's got a $1 million damage clause. It means they can't contact you, contact any employees, vendors, et cetera. Otherwise, they can be liable for up to $1 million as far as damage. The second thing that we require is proof of financials. They've got to show us that they've got some money, some assets, et cetera. There's no reason for me to send them your tax returns, your business name, any of that stuff if they've got $10,000 to their name. And you'd be surprised. There's a lot of people out there just kind of wanting to buy a business, but they don't really understand the process of going through it. And so they don't like it that I screen them that hard, but confidentiality is pretty important. Mm-hmm. And we really only want to be dealing with serious buyers, not curious buyers, if that makes sense.
Oh, totally. It's how my industry is. I'll tell you an example. Like, there's people who call me who are like, I don't know if I can buy, and they have like, $100,000 in savings. They have a 860 FICO score and, an amazing job. Then you have people who go, I can buy, and they have no money, horrible FICO score and all that, so it's funny. You want to make sure you got quality people because that's what you're working with. And I have a fiduciary responsibility that nobody knows who I talk to on my side, that they're doing a loan through me. And it's basically what you just said. People won't know who you are because there's nothing worse than people going, there's a business for sale. They must be in trouble.
Yeah, exactly. And there are people out there that just don't have the common sense that you don't just open up the door and be like, hey, I saw your business online for sale. Like, do you want to talk? Like, no, and that happens like rare, but occasionally. I've sold a lot of businesses now. I'll get those phone calls of really upset sellers. Some guy just popped in the office one day and I'm like, okay, well, it's time to call the lawyers and, send some cease and desist and some serious letters because they clearly breached the non-disclosure, but we screen it pretty hard. And so I spend the majority of my time doing that, just screening buyers, right? And I always tell my clients, hey, you're not going to hear from me. It's not that I'm not working, but you're not going to hear from me until I have a ready, willing, and able buyer, somebody who's serious. Because I've already screened them. I've given them your info. I've probably answered all the basic questions, right? And they want to do a phone call with you because they're one step away from actually making an offer.
Now, out of 100 businesses that you talk to, how many actually are good to go through the process of selling?
That's so.
Is there like 50%, 40%? Yeah.
Honestly, I don't know.
Okay.
I don't know. No one's ever asked me that. Like, most people ask me out of 100 businesses, how many sell?
What's the same thing percent? All right. So how many sell out of 100 businesses?
Yeah. So I sell 75% of the businesses that I list.
There you go. So,
but I don't take all businesses that I interview, if that makes sense. So,
and that's my question. Out of all the people you interview, what would you say the percentage of that? So out of 100 businesses that you interview, would you say 50 you might actually be that are more serious, or is it
probably less? Because I just get a lot of phone calls where people are, hey, I want to sell my business. We go through it, and it's like, you're not even close to getting $5 million. Your business is worth $1 million. Like, it's always that somebody in their neighborhood told them that their business is worth more than they think. And so they take it to market thinking they're going to get 5. And I, unfortunately, have to be, the reality crusher of, hey, it's only worth $1 million and here's why. And so that's not a business that I would take on because we're too far apart. Like, And there's some businesses that look like that, and I don't even want to deal with the hassle. There's some industries that's like, yeah, it's worth $1 million, but I'm not your guy. I don't want to spend the time and the labor to do this. Or I can tell that the sellers are really difficult people, if that makes sense.
Totally makes sense.
So I don't need the business. I value people's business. I tell everybody up front, the thing that makes me unique is I've sold 6 of my own personal companies. I treat every deal that I bring on board like it's one of my own businesses. So I'm super aggressive on your behalf. I negotiate really aggressive. I'm trying to get you the best terms, the best deal. And I'm always going to give you advice from a personal standpoint of what I would do in this situation. At the end of the day, it's your business. You can tell me, hey, I don't want to do that. We can do something else. But just know I'm going to treat your business like it's my baby and really give you the best representation that I can.
All right. So you've gone through all the process. You've got a willing, able buyer and the seller, and you decide to get, say you $5 million. And basically sorry, someone's picking up our shredding.
You're good.
Yeah. Of course they got to look in the studio instead of talk to everybody else. Going through the process. All right. Say you're going to get $5 million. What's typical? Is there a typical, you get so much up front, you get it over so many years? Is there, a normal thing for that? Or do they just write you a check and you're done?
So it's all going to depend on the client's needs, but I'm a big advocate of we try to get as much cash as possible. I really don't like my sellers to seller finance too much. And that's why you'd hire somebody like me, because I'm going to negotiate really, really hard. 1, to try to get those terms for you, but 2, to make sure we can go get the money so we don't have to do any seller financing. The reason being is if somebody takes over your business and you seller finance half of that, yeah, you got half your money and you think you're going to get the other half. What if they tank the business?
Right.
You're not getting your other half, and you don't have your business to go back into and recoup it, right? It could be in shambles. You might be able to pick up some pieces, but most likely you're not even going to be in a mental state 3 years, and all of a sudden they default. You're not going to want to get back into it. You'll just be utterly disappointed that you're not getting the other $2.5 million that you agreed to finance, if that makes sense.
It totally makes sense, because I know some people who sold it to their employees.
Yeah.
And my fear about that is your employees running into the ground, and then now you don't have a business.
Yeah. So, I've heard of those, employee buyout type of deals too, but I would be trying to get those employees to qualify for as much cash or financing as possible. Sure, they can buy it. There's nothing wrong with selling it to your employees, but are you getting cashed out? Because if you get cashed out and they run it into the ground, so be it.
Right. And that's all I kind of want to go across, is the fact that you want to get as much cash as possible up front is basically what we're saying.
Yeah, that's what I recommend. And then obviously you got to plan for the transition, getting a $5 million windfall. You've got to now focus on the transition of that money. What do you do, like we talked earlier, to keep as much of that as possible? And that's part of what we do. We're going to talk about some strategies as we exit, what you can do, where you can put the money, and how to mitigate that taxes as well.
And you want to quickly go through that real quick?
A little bit more complex than I've got.
I know.
3 minutes, but we just talk about where to place the money, right? You got a $5 million windfall. You don't want that to be taxed at 40%. Where are we going to put it? How are we going to reinvest that? How are we going to mitigate it so that we're not getting taxed at 40%? Yes, you're going to pay some taxes. You're not going to get away with paying 0. It's not going to happen. But there are strategies out there that we can put into place prior to that cash windfall, to where you can keep as much of that as possible.
Now, so in my industry, and just don't worry, I said 30 minutes. We go past this sometimes. In my industry, when people are selling investments, real estate and that kind of stuff, they can do 1031 exchanges where can you do a 1031 exchange on the business?
There's no such thing as a 1031 exchange, like from a business standpoint, meaning you can't sell one business and
then put it into other ones,
and another business of similar size or nature. But there are things, and you're probably aware of them, as far as you can take business profits and proceeds and put them into real estate, say for example, and offset quite a bit of taxable income. You can, take that, put it into the company that you own. Let's say you did an asset sale instead of a stock sale, and you still have that entity. You could take that money and you can reinvest it back into things. You could put it into a plane, a house. But you've got to have the strategy in place, meaning you could create another business and then use that capital to invest into some things to offset it. But, you're going to have a short window, right? If you sell in June, you're going to have until the end of December to pretty much figure out what you're going to do with that $5 million. You probably should know that, say, in January before the sale happens, so that when you get the money and you hit the ground running, it's quick, because it's the taxable calendar year. You've got to figure out what to do with that money within that calendar year.
Yeah, I mean, again, that has to do with having the right accountants, the right people in place while you're doing this, so you know what to do, so you can offset that and have the right person helping you through selling your business.
Yep.
And it sounds to me like you're like that person, because you care about it. It's like your baby and your own business. So I think that's really important. Anything else you want to add today, Josh, before we go?
No. I mean, it sounds like you've got a pretty good business listener base. If any of them are interested, happy to do a free appraisal form. If they've got small businesses, just have to reach out directly. Normally we charge $3,000 to $5,000 depending on the size of the business, but I'm happy to offer that complimentary.
Okay. And name of your company and how people.
It's American Business Brokers. Website's AmericanBiz, B-I-Z, brokers.com, or the direct line is 866-224-8386. I'm
sorry, I called you Josh instead of Joshua.
It's fine. That's what my friends call me, so you're good.
All right, just making sure. Because, I normally put Edward on everything. So when people call me on the phone, if they're asking for Edward, I know they have no idea who I am.
Yeah, exactly right. Yeah.
And people are like, that's a smart idea. It's like, yeah, I'm like, that's a sell call. I don't need it.
Yeah, it's similar. It's similar.
Yeah. All right, Josh, I appreciate it. Thanks so much for being here today. And I hope everybody enjoyed our episode. If you like what we do here, please share and forward. And again, Josh, thank you so much for being here today.
Yeah, thank you.